Roth IRAs are a popular tool for retirement planning due to their potential for tax-free growth and withdrawals. However, accessing these benefits isn't always straightforward, especially if your income exceeds the Roth IRA contribution limit. In such cases, direct contributions may not be possible. An alternative strategy is the Backdoor Roth IRA. This method involves making a non-deductible contribution to a traditional IRA up to $7,000 in 2025 with an additional $1,000 catch-up contribution if you're 50 or older, and then converting that amount to a Roth IRA. While this strategy has been utilized for years, it's important to understand the tax rules that can affect its implementation. Today, we'll discuss two key considerations for backdoor Roth IRA contributions and how to navigate them effectively. The account aggregation rule. The Internal Revenue Code requires all traditional IRA accounts to be aggregated for tax purposes. This means the IRS views multiple traditional IRAs as a single account when calculating taxes, which can complicate backdoor Roth contributions. Note that this rule applies to traditional IRAs, SEP IRAs, and simple IRAs, but it doesn't include Roth IRAs, inherited IRAs, or accounts belonging to a spouse. For example, suppose you rolled over a 401k into a traditional IRA years ago and it now has a $94,000 balance. If you open a separate traditional IRA and contribute $7,000 in non-deductible funds, the IRS treats these as one account totaling $101,000, of which approximately $6.93 is non-deductible. When you convert $7,000 to a Roth IRA, only about $485.10 is tax-free. The remaining $6,514.90 would be subject to income tax. To minimize taxes, you might consider rolling your traditional IRA funds into an employer-sponsored retirement plan like a 401k, if your plan allows roll-ins. Since 401ks aren't subject to IRA aggregation rules, this can help simplify the process. However, keep in mind that after-tax contributions can't be rolled into a 401k, so careful planning is essential. The step transaction rule. The step transaction rule allows the IRS to treat a series of related actions as a single transaction if they are designed to achieve a specific result. This could potentially apply to backdoor Roth IRA contributions, given the multiple steps involved. To mitigate this risk, it's important to space out the steps. Some individuals follow the one statement rule, waiting until they receive a new monthly statement before completing the conversion. Investing the funds in the interim can also demonstrate that each step is independent. However, gains on these investments will be taxable at conversion, so it's worth considering this trade-off. Filing requirements. Don't overlook the paperwork. Filing Form 8606 is essential to report non-deductible traditional IRA contributions and ensure the conversion to a Roth IRA is properly documented. Failing to file this form could result in unnecessary taxes. If you're planning to use the backdoor Roth IRA strategy, make sure to start early. Many financial institutions have deadlines for year-end transactions, and waiting until December could leave you out of time. Consult with a financial professional or tax advisor is always recommended to ensure everything is handled correctly. For more insights on retirement planning, explore additional resources, or consult a qualified advisor.